So this is a new piece of research that I've been working on that came out of a conversation, I think it was about 2 years ago, with Adrian Ash, who's just down there in the audience. I was put in touch with Adrian by Michelle Blagg, who's written a lot of alchemist articles for the LBMA, and Adrian was looking for gold prices pre-68, so I think weekly or daily, just a higher frequency for some work he was doing. And I assumed that they existed, we just hadn't found them. So I went off looking and talked to people who I thought would have the data. I talked to the fixings company. We went and spoke to the Rothschild Archive, who had ran the gold market in that period before 1968, but nobody had it, so the data was missing. So the daily price of what was a really important asset market during that period when gold was central to the world's monetary system just seemed to have gone missing. It had just been not archived. So archivists in different organizations had just not kept it, probably assuming that it would be kept by somebody else since it was such a central piece of data. So I went searching. I went through a couple of iterations, but we eventually found it. And I'm very grateful to the Rothschild's Archive for funding the data collection and transcription then that had to go on afterwards. So the data covers the fixings auction from the beginning in September 1919 all the way up to 1968 when the market shuts and then reopens in a dollarized form and when we have data really easily downloadable that anyone can find through the LBMA. So we think the data is particularly useful. The data should be useful for anyone wanting to study the gold standard because London was still the most important gold market during the period, and knowing what happened in that market must have an influence on what happened during the gold standard. Hopefully, institutions where a lot of you will work will hopefully find this data interesting in terms of risk management maybe, because there was 2 periods where the gold market was free, where the price was floating, just like it is now. And from my perspective as an academic financial economist, I'm really interested in the data in order to look at the relationship between gold and other assets in previous periods. So was gold then what it is now? So we see gold now as an inflation hedge, we see it as a safe haven against market crashes. As a portfolio diversifier, was it that then as well? So is it just kind of an accidental thing that's happened since 1968, or is it just gold's nature to do these things? So, that was my first slide. So that's just the Rothschild Archive little symbol just to thank them for funding the research. So there are lots of other sources of gold data. We've got annual prices all the way back to 1257 that are really accurate. They come from a free and public website called measuringworth.com, and that's in pounds. We've also got monthly prices available from the Global Financial Database, which is a paid subscription database, and that runs from 1723 to 1968. I know that there's twice weekly gold prices available as well through an old publication called Course of the Exchange that some people have transcribed bits of, but they're not currently available. And then from 1968, obviously, data is really easily available from multiple sources, such as the LBMA website. Where was the data? So I began looking. I thought maybe the Royal Mint would be a good place to start. They seemed like someone who would keep track of the gold price. Ordered in all of their reports, and sure enough, one of them showed up with some daily gold prices covering 1919 to 1925, but it stopped there. So I thought there was no more. I thought I'd found a little bit of data. I couldn't find any other reports, and they didn't. I called the archives there; they didn't have it either. So I thought I'd hit a brick wall. After a little while, I took a trip to the British Library, and I found this old publication called Quinn's Metal Handbook and Statistics, and that's what this little copy is from. So Quinn's Metal Handbook and Statistics did have the gold price, and for some reason had just been forgotten by the archivists and the gold market, and there it was sitting in lovely little tables, exactly as you would hope it would be for transcription. So again, I thought I'd finally cracked it, started copying out the prices, going back to the British Library, gathering up the books, and then in 1965 Quinn's stopped doing this, so they changed the format of the report. Then they just started providing monthly averages. So I thought I had this little gap, and I really had hoped to kind of fill in the whole missing series. But it turned out that there was a magazine that Quinn's were basing their data on. So that's the Metal Bulletin. The Metal Bulletin used to come out twice a week from 1913, and it covered mostly LME statistics. So it was mostly about LME data. And the articles were mostly about base metals and things like that, but it did cover a little bit of gold, and it did fill in the gap from 65 to 68 in kind of a very messy format. So once all of this had been collected, I contacted the Rothschilds, and they agreed to fund a research assistant who went ahead for me and then did the donkey work of typing this out into Excel to avoid that hassle. So this is what the price looks like when it all gets charted out. Obviously really easy to see where the gold standard periods are, down there and up here, but once the market is free, you can see there's a decent amount of volatility. The price really did vary, the price really did jump around. And even though America had a fixed gold price and things like that, the London price jumped around a fair bit. Similar to modern markets, a lot of the reports talk about it in terms of being very related to the value of dollar sterling. So the value of dollar is still very important in terms of gold pricing, and it was similar then. But we'll see when we look through the individual sub-periods that there was other factors that were driving the gold price too. So this is what the data looks like. We'll look at the individual periods in a second. But one of the other contributions, hopefully the data will make, is correcting errors that are currently there. So if you're currently paying for access to the Global Financial Database or anybody else, the Global Financial Database give you a monthly average price for sterling gold over the period, you can download. And what I've done is I've compared their monthly average to the monthly average coming from my data, and I've got some of their data from 1925 off to 1933. For most of the period, there's little differences. So this is in pounds, modern pounds. So you can see the differences are very small, and they're possibly because I'm counting in Saturdays and they're not counting in Saturdays. Yeah, so something really little like that. But you can see once you get to this period here from late 1930 through 1931 and 32, the differences get quite large, and they get large in both directions. So sometimes my price is higher, sometimes their price is higher. Yeah, so there's errors in both directions for it. The reason for this is that what the Global Financial Database did was they took the dollar price of gold, and they just converted it into sterling at the monthly average exchange rate. So it's not based on London market statistics, it's just a conversion of one over to the other. And obviously for a lot of the period we look at, the two prices are very tightly interlinked. Yeah, the two markets are very interrelated. You don't get large disparities in the price. The small differences you get back here are possibly just to do with shipping costs, insurance costs, something like that. Yeah, something small. What happens in this period is that the French government are buying gold. Yeah, during the gold standard period, they're buying gold, but they don't accept gold at the London purities. So London purity was lower, and the average bar sitting in the London vault was lower purity than the French government wanted. And that meant that they were quickly re-refining the gold to a higher standard, and you just get this bottleneck in the market where people are paying a premium for the higher purity gold, and that's where the differences come from. So the two markets were related, but this bullion market, where a lot of the gold was coming through physically, did have its own characteristics, and it wasn't simply just the dollar multiplied by the exchange rate. The dollar price of gold multiplied by the exchange rate. So you get these little differences. So what I've tried to do since then is try and build up a picture of what the market looked like. So the data is complete, and the data will be made available in time for the centenary through the Rothschild Archive website. So that's going to be made freely available to anybody who wants it, freely downloadable. But what I've been trying to do since then is try and understand what was happening in the price. So things like I came across this, didn't know what was going on, so I went looking for sources. It's too labor intensive to try and do this through daily newspapers like the Financial Times or the Financial News. But I managed to gather up the annual reports of Samuel Montague from the beginning of the period. And just last week I've managed to find that their weekly letters that they used to write from pre-1919, but definitely from 1919 onwards, are all available. I've managed to find a source for all of those to try and come up with a narrative to explain some of the stuff that was happening in the gold market. So that work has just kind of started. If you go to academic conferences, or if you've done research in an academic institution before you came to do your work now, you'll have been bored by somebody putting up their descriptive statistics of what they've done. But hopefully mine are a little bit more interesting, and it tells us a little bit about what happened in the markets at different periods. So the market we're looking at starts in 1919. That's the first day of the fixing. And you have a free gold market here until 1925. In 1925, it goes back to a gold standard period. Then it's a free gold market again up until the beginning of the Second World War. And from 54 to 68, you've got a functioning gold market, but again, the price is relatively fixed to the gold standard era. The things you can see are the return. So these are the average returns per day. So the average daily return is obviously very, very small in 1919 and 1931. And it's a lot smaller than the returns we had in the previous periods. So the markets before 68 didn't give you as high a daily return. 1919 to 1925 gave you a negative return, probably because of government policy to create some deflation. Yeah, so you had that deflationary environment, which is unusual. But even over here, you get lower returns in that period as well. So the modern gold market seems to provide higher returns. The other thing we can tell you is that the riskiness of the modern gold market is much higher. So the modern gold market is about twice as volatile on a daily level in terms of its sterling price as it was in either of the two previous periods. Yeah, the gold standard periods don't really tell you much because they're quite a fixed, quite a boring price. We'll see that in a minute. But the market was much less volatile. Yeah. Now that could be because so many more countries were on gold standards and there was less volatility maybe in currency markets, but it's something maybe to look at as we go on with the research on this data. The other interesting thing is the skewedness of the data. So this is looking at whether or not the returns of the data are more likely to be positive or negative, essentially. So we get bunching of positive returns or bunching of negative returns in the tails of the distribution. And one of the features of the modern gold market is you get this positive skewedness. So you get these big positive days that skew your data off in a positive direction. And that's one of the things that gives gold such a useful characteristics for its diversification. It's actually, Adele did research on this, Adele Tully, when she was back doing her PhD on skewedness. What's interesting is, so people had suggested to me before that this is just an oddity of the modern gold market. Yeah, so this won't continue, and maybe if you start investing in gold now, you won't get this positive skewedness going forward. Yeah, this is an historical feature that you're no longer going to benefit from. But both of our previous gold markets that were free, so slightly less positively skewed in the early one, 1919 to 1925, and then much more positively skewed, 31 to 39. They're smaller periods of time, so that's why they're a little bit more extreme. But they are sitting on either side of our longer sample, which is the current free gold market from 68 onwards. So gold has this currently higher risk than it used to be. Is that because it's just more volatile and modern markets are more volatile? But we have this useful diversification feature that it's still a positively skewed asset where most financial assets are negatively skewed. So when you balance it into your portfolio, you get some more. So I won't bother with the other descriptive statistics because they're a little bit on the more boring side. A lot of the historical work I've done so far is looking at this period. Started working through trying to explain what happened from 1919 to 1925. So it's probably worthwhile talking for a second about why the fixing came about in 1919. After the First World War, gold price had been fixed all the way through, and South African miners had been complaining bitterly and having lots of commissions and lots of conferences, making lots of representations because they were being forced to sell their gold at a fixed price to the Bank of England, and they were forced to do that while all their other costs were obviously climbing during the First World War. And they really wanted their price to rise. They really wanted to sell their gold in New York because the price was about 16% higher. Eventually, once they threatened to set up their own gold market, the British market and the Bank of England reacted. Originally, they asked Johnson Matthey to facilitate the sale of this South African gold in London, but Johnson Matthey said they didn't have the financial background at the time, being more a refiner, and instead they went to the Rothschilds. So the Rothschilds were the founding organizer of this market back in 1919. So they set up the market in 1919, and then it becomes a question of how active it was. So it existed, and the price begins on the 19th of September 1919, but it looks like the market didn't really function for a few days. Yeah, so it didn't function for about 4 days. There was no real gold being traded, and you get reports in the Financial Times saying a shipment of gold is arriving a couple of days before it starts, but won't be available until the following Thursday. And that's the first day that there's active trading on this fixing. So there's probably a small amount of gold being bought and sold, but more in ounces than thousands of ounces. Until a couple of weeks ago, liquidity in the London market was a bit debatable. So liquidity in this period is also very hard to work out, and we kind of have to infer it from a couple of different statistics. We know that in the first 5 weeks, about 660,000 ounces were traded on the London Fix, and most of it was sent to India at that period. Most of it bought up in India. As you read through the weekly circulars that come out of Samuel Montagu, first of all, they're very boring in terms of gold. They have about 2 paragraphs on gold. The first paragraph always just tells you how much gold the Bank of England has and how much they bought that week. And then the second paragraph generally doesn't really tell you anything other than America bought most of the gold on the fix, or maybe sometimes New York bought most of the gold on the fix. And that's what it tells you. I've only got as far as 1922, but that's what it tends to tell you. It doesn't really tell you what happened within the market. It does tell you how much gold arrived in New York. And one of the things we know about the old early fix was that all the gold from South Africa had to come to the fixing, and you could only export gold, first of all, if it came from, well, it says Africa, but I think it more means South Africa, and you had to have a treasury license to do it. So roughly all of the gold going to New York would have come from the fixing. So if New York was taking delivery from London, it's all coming from the fixing. And sometime during 1920, they start telling you how much gold is arriving in London. So the amount of gold per week arriving in London is between about 6 million on a good week, from what they report, and on a bad week, about 300,000 pounds. Yeah, so a very variable amount of gold being delivered. So as to what's driving it on a day-to-day basis, it looks like it's primarily driven by the dollar, but there are other factors in there too. There are other people buying. About half of all the gold, Montagu say, but up to 1925 was bought by America. About a quarter is bought by India, and then the rest is South America and kind of other people after that. They do talk a lot about the people buying being hoarders. And one of the things I was asked at an academic conference last week is who are the people who are buying it? And there is no reference anywhere really to say who are the people buying it. Tim Green, in one of his books on the gold market, says that he knows that UBS bought gold in the first 6 weeks, and that would have probably been not so much for central banks who probably would have bought directly from the fix. It was probably more small investors. Yeah, so another piece of work is to try and work out, when it came to the fixing, is it just big central banks? So if half of it is going to the US in a period when it's illegal for ordinary investors to own gold, that must mean it's going to the central bank primarily. Yeah, it must be being bought by official bodies over in the US. So who's buying it? There are reports around the period talking about people buying gold. They're always referred to as hoarders, and the IMF and people like that write reports complaining about boosts in demand for gold, especially in Europe in the 1930s. The only other thing I found in relation to this period is reference to a parallel market. So this is the official price. This is the exportable price, yeah? But in order to export, you have to have a license from the Treasury, and they'll only give licenses for newly mined gold coming from Africa, yeah, in the very beginning at least. One of the very few interesting things that these weekly letters talk about is mentioning the parallel market in scrap in the UK, or jewellery, or non-exportable gold. And it says up until about here, the prices are almost exactly the same. So if you were a local gold buyer or a local gold seller, you would be taking your price from the fix, and you would be using that probably with some sort of an adjustment for physical delivery and things like that. But from here onwards, the letters say that the market drops about 20 shillings below what the price is on the official market. So the official market, these are modern pounds. So I've converted it over into modern pounds to make it a little bit more easy to chart. But 20 shillings is about a pound. Yeah. So you see trading here is about 4.75. So the exportable price is quite high. But if you're trading within the UK, your price is down around 3.75. Yeah. So there's a big disconnect. They don't explain why the disconnect happens. That's just another set of work to try and build this picture. I've done much less work on the remainder of the data, but there's still interesting bits. This is the auction that took place daily during fixed gold prices from 25 to 31. And the volatility, it looks a little bit volatile, but these are movements of less than a penny. Yeah, so they're very, very small movements. What I haven't been able to find yet is an explanation as to why, on some days, obviously you have this kind of maximum price running along. Why were the miners selling at lower prices on other days? They really, at this period, again, were complaining about the difficulty of making any money with this price. And you think a penny is, quite a large amount. to lose if you're barely making any profit. So why are they selling on those days? That's unclear. With this period, which you've already talked about, this is when France is buying gold and paying a premium to get higher purity gold from London. So you have this bottleneck in higher purity gold. Attracts a premium. Now, technically, the fix is always trading higher purity gold, but they obviously just make an adjustment. They leave the bars in the lower purity form and adjust the price of the bar to reflect that. I really thought this was a mistake. I really thought it was just a typo in the data, because you have this fall, which looks very large, but is only about 4 pence. There was nothing about it in the Financial Times or the Financial News or any of the big London newspapers. I finally found it in the Irish Times, talking about a surprise shipment of gold that nobody knows where it came from, of about 100,000 ounces. And then it turns out the next day it showed up from Russia, but they haven't sent the documentation with it or something like that. Yeah. So it's just a sudden price shock. So even during the fixed gold prices, you do have a little bit of volatility. And if you were trading gold, obviously you wouldn't want to have had to have been selling on that particular day. Tim Green says that it is from his work in the Rothschild Archive, it is primarily a seller's market. Yeah, so people are, the miners are coming in to sell their gold in bulk, and then the buyers are taking it from that. The market goes back to being interesting in 1931 to 1939. Market becomes free again, and the prices tend to rise. I haven't done any proper historical work on this. The only thing I have done that's probably of interest is I've looked at whether or not gold was useful as a safe haven for your equity and fixed income investments during the period. So I wanted to gather up a nice equity market index for the period, but there was no good reliable one. So I gathered one by hand from the Financial News. So there's a 30 stock index that they start to publish in 1932 or 1930. And then in 1932, they start to publish a 20 preference shares and bonds, so a fixed income index with 20 securities within it. And what I do know is that it was a safe haven during the period too. So if you were a gold market investor and you were buying gold for security, and we know that during the 1930s there was a lot of gold hoarding throughout Europe, as people became worried about inflation, deflation and war, etc., that it was a safe haven against your investments. So just like it is now, when the market crashes, it's not so much that gold goes up when the market goes down, it's just that gold prices maintain. I think there's kind of a general misconception that they go in opposite directions, but it's more like the market crashes and gold maybe goes down a tiny bit, maybe goes up a little bit, but it's generally flat. The price gets unrelated at that time. So that's the one little feature or fact that I know about that period, but in terms of the history of that period, haven't got to that with any level of detail. That's the most boring market of all, because the market's closed, the market doesn't exist, but they still quote a price. But no fixing occurs from 1939 to 1954, and this is when Zurich gains a little bit of market share and starts to become a larger market for gold, because London isn't operating in the way that it used to. And eventually the market reopens in 1954. The market starts to publish data again. And again, I've got a lack of analysis on what's happening in this yet, but that will all be, as I complete it, it'll all get published and put out it'll all be freely downloadable somewhere if you want to find me on Twitter or whatever it is. But you can see there's still volatility in here. So this is a fixed gold price essentially, but we get this big spike here. I haven't yet found out what this big spike relates to, but it could be another surprise shipment coming in from abroad. And you can see the daily returns are generally very, very small, but with this one big spike in there. So it's become, and that's, that was a slide from another presentation I never took out. You all know what that one looks like. That's the current price. But you can see, if you look at the volatility down here, so these are the daily returns on gold since '68. If you go back and you compare it to what it looked like here in another free gold market, it's nowhere near as volatile. The price is much more stable. And the same again from 1919. Once you get over this original period here, where you do have a lot of volatility, 1919, 1920, once the market gets more mature and settles down, it becomes quite flat after that point. It's part of a larger project. Well, it's become part of a larger project because once I found that the gold data existed, I found that other things were there. So I've collected up these annual bullion letters. They were on a shelf in the London School of Economics, just sitting there with other journals that no one had seen in a while. They're copied, and I'm going to see if I can get those put out, asking LSE whether or not they'll let me just put them up on the internet. But the gold part isn't very interesting. The silver part is there's a lot more discussion about silver, probably because it's more of a speculative asset. So writing that qualitative history with their annual bullion letters, and now that I've found the weekly letters, hopefully that will fill in a lot more of the gaps in what happens. The gold market liquidity is another interesting point. I know that the gold markets just started publishing current liquidity. It used to publish liquidity every day on the front page of the Financial Times from 1931 to 1939. So it would tell you exactly how much was traded on the fix, and it would give you an estimate of how much trading happened after the fix in London that day. Yeah, so that data exists. It just requires some funding from some rich bank to extract it, because it requires looking at a daily newspaper every day, searching through it and transcribing it. So it requires research assistance. But that's another thing that might be interesting. We might help understand compare market liquidity and prices back in the 30s to what's happening now that we have access to market liquidity for London. Other missing data that I found was the silver data from 1913 to 1970. So that data also doesn't exist anywhere. And it's sitting there in these reports just like the gold data was. So I'm about to start looking around to see, is there anyone willing to fund the transcription of that? Similar for copper. Copper is another market that it exists for, and I want these data sets to kind of see, you have this low volatility for gold in the first free period and the second free market gold period. Is it that everything is less volatile? Are all metal markets less risky? Or is it just that gold is less risky? So, is it a general change in how London metal markets change? And a kind of a longer term project is to rebuild these twice weekly gold prices that exist in the course of the exchange data. They're already there from 1726 on, but there is more going back during the kind of South Sea bubble in London, which could be an interesting thing for market participants to look at. So I hope the data will be at least interesting to the gold market and maybe even useful in terms of risk management. I'd be really interested if anyone knows things about the old gold market that I haven't been able to find out yet. So one of the purposes of presenting this. And I'd be really interested to find out what type of research the gold market is interested in terms of this. So I think things like, was it a good diversifier? Was it a good safe haven? That hopefully is interesting in terms of, does gold have a consistent set of characteristics? But what else is interesting? So if anyone has a question or wants to talk to me afterwards, I would be very interested. Thank you very much. Any questions?
Well, I think your blip in 1962 on that chart was the Cuban Missile Crisis.
Yeah, it could easily be that, yeah.
Led to the founding of London Gold Board.
Yeah, so I think they're the type of things I need to gather up now to try and explain what look like big anomalies, but yeah. Yeah, so exactly, it could be that exactly, yeah. Now that you say it, that makes a lot of sense. Yeah.
Your positive skew in your table of numbers. If you're including, that was the period early 60s to current, yes?
So 68 to current, yeah.
Yeah. Well, don't forget that sterling went from 4, the dollar went from 4 to 1 to, 1 to 1 in 1981, 82.
Yeah.
So you've got a huge positive spin for gold prices in sterling because of currency overlay. I mean, that's enormous, actually.
Oh, it is, but it also exists for dollar gold prices. So the same positive skew exists if you look at that. So I kept it to sterling to try and make it at least a bit comparable. I know that now.
That's an exaggeration, though, because
yeah, so that's a good point.
From 4 to 1 down to 1 to 1 is
yeah.
pretty large.
But it would reflect if you were putting your money in gold to protect some of your income. It's still a real effect for you in terms of protection.
Of course.
But in sterling, yeah. Well, I absolutely agree.
If you'd done it in dollars, it would have been.
Oh, it would have been much smaller. Yeah, you're right. I tried to be consistent because it was all. But I see what you mean.
Yeah.
I see what you mean. But I suppose in the earlier periods, international gold prices seem to have been in sterling. They seem to have been dominated by sterling. Yeah. So actually, if you compare the positive skewedness for dollar gold, it's probably similar to previous skewedness. But it's still positive. And
there, but not so much.
it would be more like the 1919 period when it's like about a fourth of what it is in the 68 period. But it's still unusual. In most financial assets are negatively skewed. So even a small amount of positive skew is a useful diversification thing.